You learned that option prices are affected by three factors on a daily basis: underlying stock price, time to expiration, and the implied volatility of the underlying stock. But here's the question: how sensitive will an option's price be to each of these factors? If the stock goes up by 1 point, how much will you make on that call option that you own? If 5 days pass, how much money will you lose to time decay? If volatility drops by 10%, how much will the option's price change? All of these questions can be answered by what we call option Greeks. Option Greeks give us an idea of how an option's price will react to changes in the underlying stock price, time to expiration, and the volatility of the underlying stock. They are simply used to measure an option's price sensitivity to each of these factors. These option Greeks are important to learn and understand because they actually help us choose which strike prices and expirations to select when placing trades. And they also help us understand our risk, which is crucial to successful trading. There are four main option Greeks: delta, gamma, theta, and vega. Let's first talk about delta. Delta is a measure of how much an option's price will change in value if the underlying stock price goes up by 1 point. So if an option has a delta of 65 cents, then that would mean if the stock goes up by 1 point, then the option contract will go up by 65 cents. The delta is 47 cents. This is telling us that if the stock price goes up by $1, then this option contract should go up by 47 cents. This is important to know because if you own one contract of this call option, then that tells you that if the stock goes up by 1 point, you should make $47. Simple enough. Delta is the amount by which an option will change in value if the stock goes up 1 point. Now here's the thing about delta. It is not a fixed number. As the stock moves around, delta will actually change, and it will change by the value of gamma. Let's talk about gamma. Gamma is the amount by which delta will change if the stock moves up 1 point. So for this option, you can see the gamma is 5 cents. What this means is if the stock goes up 1 point, then the delta, which is currently at 47 cents, will increase by 5 cents. So the delta would go from 47 cents up to 52 cents. Now, don't worry yourself too much with gamma at this point in your trading education. We actually don't even look at gamma much when making trading decisions. It's more just about understanding the concept and understanding that delta will constantly be changing. What's important for you to know right now is that as an option becomes more and more valuable, its delta will be increasing. Okay, so you just learned about delta and gamma. These are the two option Greeks that help us understand how an option's price will be affected by changes in the underlying stock price. Now let's move on and talk about theta. Theta is the measure of an option's sensitivity to time. Theta is the amount by which an option's price will change if 1 day passes. So for example, the option you are looking at has a theta of negative 12 cents. So if 1 day goes by, then this option's price will lose 12 cents due to time decay. Now, keep in mind, this doesn't mean that this option will for sure be 12 cents lower tomorrow, because remember, all three of these factors will affect an option's price each day. What this does mean is that if the stock's price doesn't move and implied volatility doesn't change, then the option's price should be 12 cents lower than it is now. And theta is the amount by which an option's price will change if 1 day passes. Now, there's one more option Greek, and it's called vega. Vega estimates how much an option's price will change if the underlying stock's implied volatility changes. To be specific, an option's price will change by the amount of vega if implied volatility goes up by 1%. So looking at this option, you can see that its vega is 10 cents. This simply means that if the underlying stock's implied volatility goes up by 1%, then the option's price will increase by 10 cents. Delta is the amount by which an option's price will change if the underlying stock price rises by 1 point, Gamma is the amount by which an option's delta will change if the underlying stock price rises by 1 point. Theta is the amount by which an option's price will change if 1 day passes. And Vega is the amount by which the option's price will change if the underlying stock's implied volatility rises by 1 percentage point. We talked about how each of these Greeks will give you an idea of what an option's price will do as each day passes and the underlying stock's price and implied volatility move around. See, the delta on this position is negative 8.98. This means that if SPX goes up by 1 point, then the P&L of this position will change by negative 8.98. So if our P&L changes by negative 8.98, then that means we will lose $8.98 from where the trade currently is. We're already up $425 on this position, so if SPX goes up by 1 point, then in theory we would lose $8.98 of that. So now we would only be up around $416. On the flip side, this is saying that if SPX goes down by 1 point, then we will make $8.98. This is because the delta is a negative number. And that's one cool thing about viewing the delta of our position is that it tells us if we are long or short the underlying stock. In this case, our delta is negative. So we are short SPX and we want the underlying market to go down. So a negative delta indicates that you are short the underlying market and want it to go down, and a positive delta would indicate that we are long the underlying market and would benefit from the price going higher. Another cool thing about looking at the delta of our position is that it tells us our directional exposure, and we can make sure that that number is in line with our risk tolerance. If this number is bigger, then that means we are more exposed, right? In this case, we traded 10 contracts and our delta is negative 8.98. But let's say we traded 100 contracts on this trade instead of just 10. This number would be around negative 80 instead of just negative 8. If this were the case and SPX went up by 1 point, then we would lose $80 on the position. So delta is a good way to measure risk. And keep in mind, I said it's a good way, not the only way. Now, a delta of negative 8.98 is actually not that much. It's almost insignificant. And that's really just the nature of the Iron Condor strategy, and that's why the strategy is so powerful, because we can let the trade make money from time decay and volatility and remove stock price from the equation as much as possible, since predicting stock prices is very difficult. That's kind of beside the point right now, and again, you're going to learn about this strategy soon. But for now, just understand that this delta is saying that if SPX goes up by 1 point, then the position should lose $8.98 from its current state. So one last thing about delta before moving on. How do you know if a delta is big or small? Well, really it's subjective and it depends on your risk tolerance and account size. But for any of you who might have a history of trading stocks, one way I like to look at it is this option position is the equivalent of being short 8 shares of SPX. Now, I realize SPX isn't a stock, it's an index, and the index itself isn't tradable, but you get the point. Your delta basically tells you the equivalent number of shares you are long or short of the underlying market, right? If you are long 50 shares of a stock, for example, then your delta would be plus 50. Because if the stock went up by 1 point, then you would make $50. So if your option position shows a delta of negative 10, for example, then that's the equivalent of being short 10 shares of the underlying stock or market. Now, of course, this delta that you see can change, and it will change by the amount of gamma. So in the case of this particular trade, if SPX goes up by 1 point, then our delta will go from negative 8.98 to negative 10.57. Don't get too hung up on gamma. Again, it's really not something we look at much, and it's more just about understanding that your delta will change as the stock moves around, which can increase or decrease your directional exposure. So again, gamma is the amount by which your delta will change if the underlying market goes up by 1 point. Now, just a second ago, we mentioned that all options have a negative theta because all options are constantly decaying as time passes. But if you look at our position theta, you can see that the number is positive. What this means is that this position is benefiting from time decay. Or in other words, for each day that passes, this one position is bringing in $72.63 from time decay. This is pretty cool because all the strategies we use here at Skyview Trading benefit from time decay. Making sure you are on the right side of time decay is extremely important. So again, looking at position theta will tell you how much your P&L will change due to one day passing. Now, the last option Greek we'll talk about on this position is Vega. You can see that the Vega on this position is negative 176.78. This means that for every percentage point that implied volatility goes up, we will lose $176, and inversely, for every percentage point that implied volatility goes down, we will make $176.